Hello, everybody, and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. My name is Jesse Day. Before we dive in, standard disclaimer: nothing here is investment advice. Do your own due diligence. And today's guest is an expert at technical analysis, a gold and silver aficionado, and the co founder of Northstar Badcharts.com. Someone I always love talking to, Patrick Karim. Welcome back to the show.
Hi, Jesse. It's super fun to be back there. I don't know how long it's been, but I think your channel was kind of starting when I was with you. But I'm so happy to see your channel's grown. It's fun to see hard work. It pays off over time. It's great.
Thank you. Yeah, I think we were at around 10,000 at that time. We're coming up on 40,000. So definitely that's because of great guests like you and all the knowledge that you share on this channel. So really appreciate it. And I do want to start this time around by unpacking a tweet you made recently that I found particularly compelling, where you said, reading all the posts this morning on total public debt surpassing 33 trillion, I see many are still under the fiat illusion spell. Who cares about 33 trillion in total public debt? It could be 1,000 trillion and it doesn't matter. What matters is how does that debt look like denominated other than with fiat, thinking I still have much more work to do and help wake up the crowd. So help wake up the crowd. Could you expand on that for us and what you were hinting at?
Yes. So this is the fiat trap illusion because people have there's these clickbait numbers. Oh, we've added 1 trillion in the past quarter, but what were people saying in the 2000s or even in the 80s? I don't know what the debt was, maybe 40 billion, and then it goes to 60 billion. I'm sure that was headline news. Oh no, debt, they added 10, 20 billion. But you look in the river mirror and you say, well, okay, we're still, everything's still going around there. People still have jobs. It's not the end of the world. The economy is still going. So those numbers, you got to, if you take a step back, you have to say, okay, what's wrong with these fiat numbers? There's zero added. My quart of milk, I don't know in the States what this, or my liter of milk, it used to be 25 cents. Then it was $1, then $2, now $5. But it's the same milk. Those physical goods are the same. The ounce of gold used to be, and 1 ounce of gold has not changed forever. It used to be $40, then 200, then 1,000, then 2,000. Gold hasn't changed. Why are we adding zeros to it? Oh, it's more in demand. Well, there's short-term supply and demand mechanics that could probably justify cycles. But when the price, it's always higher lows. When you go to 40 to 100 to 80 to 200, when it's skewed upwards, it's something else driving that channel of supply and demand, or that price channel going up. And that's the destruction of purchasing power. It's fiat. And I've really been focusing on that recently to showcase charts, because charts help you give you a visual of what's happening to our fiat. So when I see that debt, for me, okay, 33 trillion, that's fine. But how is that 33 trillion when let's say we denominate it in gold? How does that look? Are we at all time? Do you think we're at all time highs in debt priced in gold? I'm going to throw that question out to you. And it's fine if you don't know, but with a chart, I could show you that the debt used to be higher. We're not at peak debt right now. So even if nominally debt is 33 trillion, I could show you a chart right now. I'll show you my screen. Debt, total public debt divided by gold. So here I have debt priced in gold, and I'll just show you total public debt, what it looks like. Total public debt. And that's what everybody looks like. They always look at debt denominated in fiat. But because of destroying your purchasing power, look at that. The debt since 1966, look, it's just been going from bottom left to top right. But when you price it in gold, and gold tracks your purchasing power, it tracks the US dollar strength versus other currencies adjusted for inflation. Look at the peak debt was in 2001. That was peak debt priced in gold. That was the peak. We haven't surpassed that yet. In 2015, it was going up. It got halted here, not resistance. In 2018, it tried to go up, got halted at resistance. In 2022, I'm going to zoom in for you guys. It tried to break out, even on the monthly chart. Debt price in gold was breaking out, but that looked in hindsight, it looks like a false breakout. The next month it went back down, and now debt priced in gold is below $1 2, 3, 4. A valid trend line, Jesse, is 3 bounces on the line. That trend line morphs into existence. A break on the 4th, and then you have a breakdown. So the momentum, the upwards momentum of debt outperforming price in gold, that upwards trajectory we've had since 1982, right? When the rates have been going down, 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 with peak debt here in 2000. Here after that, there was a correction. Now debt has started rising versus gold again here. It's lost its upward momentum. All that sideways grind now is making this very vulnerable for debt to implode or to go down priced in gold. So while the debt might go up, what that means is that ratio could go down because the debt could go up and gold could go up at the same time, except that now gold will outperform debt and have that ratio go down. So it's all about a question of, how can I say, sustainability. If gold is able to get repriced or priced to reflect the true destruction of purchasing power, that means there's more inflation. That means that debt is not worth as much as it used to. It's not that 80 trillion of debt, that 33 trillion of debt is not able to buy you as much as that 80 billion of debt we had 40, 50 years ago. You see how by measuring against something that's real, that's doesn't change, you see the true mechanics behind it. So I'm not too worried about that $33 trillion debt. It could go to 50, 60 before anything implodes. I'm more worried that if that debt priced in gold breaks out there and goes parabolic, that's going to scare me because that's going to tell me something's wrong. The debt is outpacing commodities that are supposed to price in that destruction of purchasing power. And that goes too high, then we could have some hard event. But right now, it's just steady as she goes. As long as gold outpaces debt, there's I have no worries at all there for that nominal number.
Very fascinating. So, do you see a recession up ahead and a debt crisis up ahead? You're saying that because when we're looking at it priced in gold, it's lower than it's not too close to the all-time highs. You were mentioning that was in what year was that when it was at all-time highs?
2000, the dot-com bubble, 2001.
Okay. So, I have a lot of people on this show who forecast a recession, a broad market crash, some kind of massive debt crisis, some kind of massive financial crisis. The Fed is going to break something. Some guests even talking about that's going to lead to hyperinflation of the US dollar. What's your view on the broad economy based on that gold to debt ratio?
So we could unpack this. Maybe the precious metals. I'm going to show you my silver chart with the recessions overlaid. Let me pop, because I'll tell you something. While everybody is looking at the Fed to tell us if there's going to be a recession or not, the metals, the aggregate of market participants, and I keep repeating this, all the people who follow the Fed meticulously, every single word they do, right? And these people that have these big computers to crunch all the analytics of all the inputs and all that, eventually they're going to buy or sell on the market. And there's another guy with a supercomputer crunching all those fundamentals, those macro. He's going to buy and sell. But at the end of the day, we're going to see that in the price chart. And look at the silver chart here. I have the silver chart since 1970, and here are the gray overlays, or green. I'm colorblind a little bit. To help me with the color, is that light green?
Yes.
Those are recessions. And silver loves to bottom in the abyss of a recession. Here in the 70s, had a small dip. Of course, it went down lower, but the recession was around that area. Here in 1974, silver goes rockets, goes back down, abyss of a recession. 1980, look at that. Silver just plummeted. The abyss of a recession. 82, 91, 2001, silver bottom in the abyss of the recession, the recovery going up. 2008, exactly in the middle of the recession. 2020. Look at this huge move we had down a few months back there, or even 6 months back. Remember when everything was imploding here? Back then, I had a suspicion that they could have easily backfilled a recession back here. But okay, this is a takeaway, guys. No matter if they officially backfill or not a recession, it doesn't matter, because the precious metals, gold, silver, even copper or oil, if they're V-shaping, if they're crashing downwards, they're pricing in the possibility of that probable recession. And if it recovers, then fine. Then if they backfill the recession, we're probably going to be already on the way out. Because remember, these recessions here, I don't know when they declared when they backfilled the recession here. Look, they have the recession here officially starting in 2007. I'm pretty sure in 2007, nobody was telling us we were in a recession, right? Even 2008, when did they declare we were in a recession? Maybe in the abyss of the recession, they started, oh, okay, maybe we're in a recession. But the metals knew, the market participants, they know that the recession, and all these precious metals, gold, silver, they love the recovery. So we could have had a recession here, but look where silver is now, Jesse. It's on this continuation breakout line. One touch, two, three, four, five. There's so many touches of that line. So the more touches, the more important that's a resistance. But a resistance line also is a breakout line. And if we close above a breakout line, then that line becomes support. And then we have some type of crazy move like we did here. Look in the 80s, 1, 2, 3, 4, then break out. And then after that, you don't even look back. You're in a 5, 6, 8 year recovery. For me to tell you that if people always say there's a recession, just look at the metals. If silver doesn't crash, if silver doesn't do a V shape like it did back here, there, and doesn't start going down, recession fears, you got to put that on the back burner. Or if there's one, it's not going to be as violent as the 2008 crisis. And if silver breaks out, there's no recessions. There's none until silver moves up. It reaches its measured move, 36, 40, all-time highs, whenever it decides to go to peak. And then if silver starts crashing, putting in the top and crashing down, then say, okay, something's happening. They're probably going to declare a recession in hindsight. So forget what those talking heads, they tell you recession or not, people predicting a recession. Just look at the metals. If silver breaks out, then who cares if they say people think there's a recession or not? It's breaking out. The price is actually going up above an important level. I don't see why you should live in fear of a possible recession. And it's kind of contrarian that people are calling recessions, and then you're there and you look at the chart. Look, we could even talk about uranium. Uranium, like going bonkers. Yield, like what are we doing here? Uranium wouldn't go bonkers if there'd be a massive recession coming up. I could overlay the uranium, the oil, the silver chart. They're all practically track each other. The ebbs and flows are different, but so look at the charts, guys. If silver breaks out, it hasn't broken out yet, but uranium has, then you got to be like, you want to make money, right? You want to ride a trend. And if you're afraid to buy the next silver breakout because you're afraid of a recession, well, you're always going to be one step behind because you're listening to the news, not the price. You let me rant for too long, Jesse. You got to stop me.
No, that's why I'd love having you on the show. I want to hear all the details. I know the audience does too. And I wanted to have you bring up another chart here. And that is a very interesting chart you posted on banks being very close to total collapse priced in oil. So could you walk us through that and the implications you're seeing there?
Okay, so I have Bank of America. I think that's a pretty big bank, but I like using that chart, guys, because it has data going back to the 70s. And the more data you have, it's like a scientist, right? You can't do a small test on a small sampling rate, right? You need at least 1,500 people in your sample to have something that's scientifically, with that 1.5 or 3% risk, that probability of error. So bank divided by US oil, guys, on the monthly chart. Whenever the banks were in a severe downtrend versus oil, energy, and also a proxy for inflation, right? That means the capital flows, instead of going into that asset class, they're going to favor whatever that energy, right? Whatever the assets outperforming. Look at that in the 70s. As Bank of America was getting whopped by US oil, we all know that the 70s was gold, silver, crude oil, even uranium. That was a bull era. Here I have at the bottom chart here, I have silver just going bonkers. We all know what silver did, right? It was a bull era for silver, went over up 1,700%. Until here I could have drawn a breakout line. Bank of America breaks out versus energy. So now capital flows, they're shifting in that disinflation, right? Higher interest rates all the way going down. And here's just a beautiful, beautiful move for Bank of America until it tops in 1998, tries to do a secondary, try to go back up, can't do it. Starts faltering below important moving average. Now discovering morphing an eventual breakout line to existence. Tries to go back above here, which I call the echo bubble. And echo bubbles, guys, technically, it's where everybody says, "Oh man, okay, we're done. Bank of America is going to the moon," but they forget that previous support, once broken, becomes resistance, and it failed to go back up. And after that, all we know from 2001 all the way to 2009, oil went bonkers, and 2001 all the way to 2011, or gold, silver. It was a bull era, guys. And look where we are today, Jesse. It's like, I don't want to say bonkers so many times, but 1, 2, 3 points on the trend line, so it's valid. And now I probably have to update this chart, but I'm pretty sure it's still breaking down. So that's from September 16th. The price action on the monthly chart is below this rising trend line, which tells you, depending on the angle of the trend line, tells you if the momentum is slowing down or not. And that's it's pretty much the same angle as it was back in the 80s, 90s, 2000. Breakdown, that echo bubble could not go back above the moving average, could not go back above the wall here. Look, it is what it is. The trend now is bias neutral, but heavily now. Soon we won't say neutral anymore. You have to start saying that the bias is bearish for banks, financials to underperform energy, uranium, oil. I could have uranium's like even more in favor, and that thing's just falling. And I'll just give you some technical stuff, guys. If you want to use volume to spot tops or bottoms, everybody's talking about volume on breakouts. Fine. But look at this huge spike down. Look at the huge volume coming in. It created a bounce. Here, another on the secondary bottom, the double bottom here, huge volume. And that was the final bottom. Of course, you don't buy the bottom. And if we cover that natural gas chart, Jesse, I'll show you why you don't want to buy bottoms. But it gets your attention on the chart. And after that, once it closes back above a moving average, and I could have put a breakout line here, then you get back in. So I'll just close up with silver on that chart. And look at silver, 1.234.5. That trend line here is massively important for silver. As that unwinds downwards, and we've seen in the past when energy goes in a secular bull versus banks, silver has always done well, always done well. So it's a question of time now. As soon as silver has a confirmed breakout, then this is probably going to continue unwinding, just fueling the capital flows, leaving banks, growth stocks into commodities. So that's look, yeah. Even nominally, Bank of America, I checked it today. There, even nominally, it's starting to fall apart. Just nominally. And now, when you adjust it for something that's going up in price, that chart's just like so much headwinds. It's always about headwinds versus tailwinds, guys. Probabilities. It's not a coin flip, TA. If you're buying in a basing pattern or a topping pattern, again, the natural gas chart, I'll show you. That's a coin flip because you don't know if a basing pattern can become just a continuation pattern down, right? Price goes down. Oh, at the bottom, it's going sideways. But if you buy too early, don't wait for the breakout. Oh, I broke down. So in hindsight, you see that was actually a halfway pattern going down. You need to wait for the pattern is only a pattern, guys, after it breaks out. That's a basic premise of chart trading. Targets, implied measure moves, time to reach targets, and patterns. I could have a triangle. Oh, it's a triangle. It's a triple top in gold. Everybody's talking about the triple top in gold. Well, it's only a triple top if it breaks down. And that's, oh, yes, it was a triple top. It's not a triple top if it's the chart still morphing into existence, because you're bouncing on the resistance line or breakout line and you failed to break out on that attempt. It doesn't make it a triple top. The breakdown confirms that it was a triple top.
Fascinating. I want to touch on uranium because you mentioned that a few times. I spoke with you on the VRIC channel with Michael Oliver, and you give an excellent breakdown of the uranium sector. The spot price has now risen to 12-year highs. The equities are also rising. Everybody's excited on uranium Twitter right now. So are we set to take off here, or are we overbought and potentially could see a leg down, a correction from here?
Yes. Well, I think the questions for that is yes and yes, because it's all about timeframes, right? You have to know the breakout. Is it defined on the daily chart or is it defined on the monthly chart? So if I have a breakout defined on the monthly chart, then yes, it's gonna rocket upwards, and I have parameters on the monthly chart to know how stretched I am from the moving average, and then where should I take profits, etc. But then on the smaller time frames, I could zoom in and I could actually have a breakdown, a bearish cycle happening on top of a rising bullish channel, right? And that's what's going to create the next swing low. And as long as the new low is a higher low and the next high is a higher high, then you're just in an uptrend, right? Here's your uranium miners, guys. That chart, I've been tracking that chart for a while. Monthly chart, log scale, this is uranium miners. It had a great run up. That was the everybody got excited here back in December, I think, of 2020. Just shot up. Now here it was super stretched from the moving average back then. So when everybody was getting excited, unfortunately, when everybody gets excited, you have to look at the charts, because whether it's Bitcoin or Nvidia or like even uranium, when all those uranium bulls there, they start going bonkers, you have to look at the chart because you're probably stretched from moving average. Huge volume. Remember I showed you the volume there on the capitulation for the Bank of America chart? It works on the upside also. So when you have a blow off top in volume like you have here, people say, oh, inflows, it's crazy inflows going in uranium miners, we're going to the moon. Well, that huge volume often accompanies a top. So we have a top, doesn't mean you're going back down to zero, but you need to let that longer term 3-year moving average catch up. And that's what uranium has been doing for for over a year, right? Almost 2 years we've been consolidating. And look what's happened during that consolidation, that sideways move, letting the moving average catch up. The volume has dried up. That's beautiful. So it's like some hidden bullish divergence. Volume's going down, sentiments resetting. Nobody's saying, oh, crazy inflows. Like, all these uranium accounts, like crickets when people post stuff, beautiful. But the price just went beautifully sideways. And it had a crazy bounce here on the 3-year moving average. And now it's rocketed all the way to, on the shorter time frames, there's a breakout here. And now it's rocketed all the way to this more critical, longer term trend line. And that's probably where we're going to start slowing down a little bit. So is it going to slow down and then let that moving average catch up and coil again? Possibly. But the takeaway is you're in an uptrend. Higher lows, higher lows, higher lows. And as soon as we do a higher high here than the previous peak we had in 2020, it's game on. That's a pull flag. And it's just a beautiful setup there you could have for uranium miners. Yeah, uranium futures, just epic stuff. Let me put the monthly chart. Look at that thing. Descending trend line. I could put a thicker line. Maybe it'll be easier for the viewers. So when you have a descending trend line, 1, 2, 3, a break, you don't go all in here. That's just the first sign that the downwards momentum is slowing down. Just like I showed you on the charts slowing down, you see I inversed it just to show you, like for the Bank of America chart, when you have a rising trend line, doesn't mean it goes down to right away, but it means that the upwards momentum is slowing down, and you don't want to be there when that happens. You want to go in something that the momentum is expanding away aggressively from a moving average. And right here, look at that momentum going sideways, break above the cloud, a dip here, hitting that 3-year moving average. And it's just been rocketing since then. It's like bounce on the 3-year, bounce on the 3-year. And after that, it's just been holding the 1 year. So if you're holding the 1 year and not even dipping to the 3-year, that means the momentum is only slowing down to the rhythm of the 1 year moving average. It's not even taking a deep breath to the 3-year moving average. That's how powerful it is. And that thing has just broken out, pull flag, just broken out and just rocketing away. If you want to know when this thing could slow down, well, here below I have distance from my 3-year moving average, Jesse. I know I've previously reached a peak. I'm able to distance myself 81% above the 3-year moving average before that we had that important consolidation. So what I do is I put 81% here on my measuring tool. And then I just add it. Here's the 3-year moving average, the red line. Add it on top. So if ever uranium was to rocket from here and stretch all the way up here in the next couple of months like it did before, then I would definitely strongly consider taking profits right here. And it's going to be, like, if uranium hits over $80 there, I think everybody's going to go just ballistic there. This is going to be huge. But when you look how stretched you are from the moving average, that's probably going to be a great time to take profits. And it scales upwards. I'll just add a little more visual for your viewers here. So here's my projected 3-year moving average, right? As long as the price is above, the 3-year moving average is just going to keep going up. So I could imagine that it's going to keep this angle. this is a sliding target. So if we take a few months, you see how I'm anchoring the bottom of my 81% to that red line. So if it keeps moving up, my target here in time moves up. So we might be at $90 by the time I'm stretched 81% away from my 3-year moving average. So if it takes its time to go up, which is great, we don't do that blow off, that candle burns brightest at the end. We don't do that moment until further back. That'd be much healthier, and it'll make us get more profits if it'd be able just to slow down a little bit there. Something like that instead. Then we'll be able to have to fetch a higher price before this thing burns out. But if it just goes bonkers, like, whoops, if it just goes bonkers from here and just goes up in a straight line, then our profit levels are going to be, we're going to have to exit like really, really soon there.
Let's shift to the energy market now and start with oil. WTI crude having broken above $90 a barrel. Many people are calling for $100 oil up ahead, even beyond. What are the charts telling you about oil?
I'll just preface, the last great entry for oil was back here. So this chart was from July 8th, 2021. Beautiful double bottom, horizontal breakout line, reverse symmetry moves. And that was the last great entry right here for oil. After that, it just went bonkers. It hit 100, 107, 115, I don't know how, 120, and then it did a severe pullback. So it brings us to today. What's the chart after having this bonkers move? Where are we today? I'll just remove all my drawings. I'll remove maybe the Ichimoku cloud to clean it up. Right here, 1, 2, 3, up, little noise here, bounce on that super important trend line that dates from 2008. Now it's back above the 1 year, it's above the 3 year. So that's a pull flag. I'll show you a little bit how that works. Pull flag, arrow here. It all depends how greedy you want to be. I'll show you how to do a measure move. So even if I take that small move up, it should bring me back to 112. But before you reach 112, you got to zoom back out and look always to the left. And that's the advantage of the chart. Look to the left, guys. And here's the congestion area. Blow off top. Can't back above this wall here. Can't get back above the wall. That resistance, falls. Here, it stutters around this breakout line, goes here. And look at that. Years later, it halts exactly where all these peaks halted. So for a call right now to go back to 112, it's definitely in the cards. There's maybe this congestion area here, a little lower here. See where I have a high volume node right there. Often people look at the peaks as targets, but the wall again is a support turn resistance. And right here, as that broke down here, support broke down. So that support now becomes resistance. If ever we get back above, and this is probably a better way to draw it. Just going to remove this line here. Always use the squiggly line, guys, because the squiggly line, I'll be able to, maybe something like this is possible here before that moves up. And then you'd have a stronger base here, and then a reverse symmetry move to complete the move back to 112. So this also is possible. How shallow, how deep is that consolidation going to be? Well, then we'll see where the 1 year moving average is, the 3 year. It might just bounce. I'll put back my curved line. It could just bounce here and then get squeezed up. So definitely possible. It's even healthier if that thing doesn't go rocket all the way up here. This would be much healthier to have a sideways grind here for 2-3 months and people give up and then you break out. And that would be more meaningful than a V shape all the way here. And then you just burn that candle too fast, right? You don't want that. So this is definitely possible now in the works. Look, you cannot, the targets for right now, once we breach that 95, 94 area, you have to look upwards because you're above an inclining 3-year moving average. You're above a massive base amongst all the other evidence. Again, uranium going bonkers, etc. All that evidence, it adds up. So your bias, your probabilities are that oil will continue up. If it if it doesn't, if it falls below that 3-year once again, then we could be dealing with a much bigger pattern in play before that eventually plays out. The market's going to tell us, guys, don't fight the markets. It will tell us how ready it is for that continuation of that bull run. So yeah, but it's looking good though. It's moving up. So that means that support has done its job and has created the opportunity for oil to bounce up and stretch away from its moving average. I'll do one more exercise to give some more clues for the viewers. Here, I have again distance from 3-year moving average. It stretches historically. It's able to stretch about 80% above the 3-year moving average. And that's my FOMO guide. How far can I stretch? So let's say I put 80%, 79, my 3-year moving average. So there's enough fuel tank before we have a very important 2-year consolidation, 1-year move. As long as it stays above the 3-year moving average, our target is actually all-time highs are back to 140, 150, depending how fast we go up, right? So there's a lot of fuel tank. This is another way to say it. Whenever you're close to an important 3-year moving average, and you've been coiling close to it, those are the low risk, high reward opportunities. And it's in front of us there. It's happening. It's unfolding right now.
So we've talked about oil. Let's now touch on natural gas as well. It's been consolidating sideways since February this year after tumbling from over $9 in September of last year. So are you expecting natural gas to rise from here, and could we reach that $9 level again?
I remember natural gas as it was plummeting. Some people saying, "Oh, I'm buying natural gas here," and then I was okay. I'll look at this chart here. I have the quarterly chart for natural gas. You have a tweezer tops. It's just terrible, just plummets. And people were talking about buying here, and the only thing I see here is a falling knife. Never buy a falling knife. You'll see in the pattern before from 2006, 8. It just there was huge opportunities and went down, violent bounce up, bounce down, lower highs, lower lows. Not a place you want to be until it breaks out. So when I saw that, I said you got to stay clear of natural gas, and you'll see here I have even back then I had a $3 level that was clearly identifiable. I'm going to go on the interactive chart. Here I have about the same level, $3. So after I did that chart, natural gas kept going down. Sure, bottom people probably bragging rights. Oh, I caught the bottom, but it still hasn't broken out above $3. This wall, it's critical because you just don't know how long that wall is gonna hold, right? You could be holding that thing. Let's say you're buying options and they're going to expire, because the true fast move is going to be above this wall, how the price is really going to go up. So natural gas, is it going to go back to $9? Well, the probabilities of natural gas having a fast and furious move are above the $3. And until it clears $3, this is there's absolutely nothing to do with natural gas. You just step aside, let the market morph that chart, creating a low risk entry. Then you have a chance of going in. But right now, I wouldn't touch that. But just like a reminder, there's some, they don't come offhand there, but there's some natural gas plays that don't look like this chart at all. So even while natural gas, the price of it might go sideways, like below $3 for months and months and months, or go lower before it breaks out, there are some natural gas companies, maybe because they're leveraged with oil also, that do look pretty good, and they're looking more like the oil chart already on the move, right? But for natural gas futures traders, if there's this is definitely no man's land right now. You can't touch that.
Well, thank you so much for joining us today, Patrick. Always love talking to you. You have a very unique take, and your technical analysis skills are a breath of fresh air. We talk mostly about the fundamental side of things on this show, and like you always say, look at the charts, and I think they tell us a lot. So for those who want to learn more about technical analysis, could you tell us about NorthstarBadcharts.com and what it is you do there?
It's all our knowledge, mine and Kevin Wadsworth, North Star Charts on Twitter. There, it's like we've just combined forces to just give value, in-depth commentary, We talk for members, like, we have the full service thing, I can't even name. Just go on the website, guys, northstarbadcharts.com. Just go see there. It has like everything you would ever want. Entries, exits, heat maps, like it goes on and on. But yeah, go check it out. There's a free 30-day trial. But like, other than that, if not interested, just go on Twitter, guys. It's a wild west there. It's fun. Badcharts1 on Twitter. Follow me there. Follow Jesse. Follow all his guests. And just enjoy the ride, guys, and keep learning every day. That's what you have to do, man. If you don't learn every single day, then you've missed an opportunity to make yourself better.
Absolutely. Well said. And I will put a link to northstarbadcharts.com as well as your Twitter. Highly recommend people follow you because you post a ton of fascinating charts, just like the ones we've been looking at today. So thank you once again, Patrick, for coming on and sharing your knowledge with our audience.
Thank you, Jesse, man. You're the best.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.